The number you see on the screen, the one that flashes green or red, the one that dictates the mood of Wall Street and the headlines of the evening news, is a siren song. It is the most seductive, most compelling, and most dangerous lie in the world of finance. That number, the stock price, feels like the truth. It feels like a verdict, a final judgment on a company's worth delivered by the infallible wisdom of the market. And for 99% of people who attempt to build wealth, that flashing number is the gravitational center of their universe. They orbit it, they pray to it, they fear it. But the single greatest secret, the foundational truth upon which fortunes are built and dynasties are secured, is that the stock price is nothing more than a distraction. It is noise, not signal. It is the opinion of a crowd, and crowds are notoriously fickle, prone to fits of euphoria and bouts of terror. The real work, the work that separates the speculator from the sovereign investor, is done in the quiet, away from the ticker tape's frantic dance. It is the work of a business owner, a proprietor, who cares not for the daily gossip of the marketplace, but for the steady, thrumming engine of commerce that lies beneath. It is the discipline of calculating what a business is truly worth, what its durable, sustainable earning power can deliver into your pocket, and then waiting, with the patience of a predator, until the manic crowd offers you that entire business for a price so ludicrously cheap that the purchase itself becomes the primary shield against risk. This is the principle of the margin of safety, framed not as an abstract academic theory, but as a practical, actionable test. It is the billionaire's test for knowing when a stock is truly, undeniably cheap. It is the mechanism that prevents the two great sins of investing: buying a business that is cheap for a very good reason, a value trap destined to sink, and the far more common sin of paying too much for a wonderful company, turning a potential triumph into a decade of stagnant regret. Today, you will learn the framework to perform this test. You will learn to see the price as a mere suggestion, and value as the bedrock of reality. This is not about charts or trends or whispered hot tips. This is about learning to value a business as if you were going to buy the whole thing, from the front door to the loading dock, and in doing so, you will acquire a financial transformation. You will gain a permanent, durable method to separate fact from fiction, enabling you to confidently buy the world's greatest businesses, but only when they are on sale, dramatically and permanently improving your odds of building real, lasting wealth. The first step on this journey requires a fundamental rewiring of your perception. We must dismantle the illusion that has been carefully constructed around us since the first time we ever heard the words stock market. We must learn to see price and value as two completely separate entities, one a frantic emotional phantom, the other a solid, calculable reality. This is the great price-value illusion, and understanding how to shatter it is the prerequisite for everything that follows. To do this, we must travel back in time, to a period of immense national turmoil and profound market pessimism. The years were 1973 and 1974. The United States was reeling. The Watergate scandal was exploding, eroding public trust in the highest office of the land. The Vietnam War was a festering wound. An oil crisis had sent shockwaves through the economy, leading to long gas lines and rampant inflation. The stock market, a barometer of national mood, was in a state of catastrophic collapse. The Nifty 50, a group of celebrated, supposedly one-decision growth stocks, had fallen from their pedestals, with giants like Xerox and Polaroid losing over 70% of their value. The sentiment was not just bearish, it was apocalyptic. Investors were convinced that the American enterprise was broken, perhaps permanently. And in the midst of this chaos, the stock of one of the country's most prestigious institutions, the Washington Post Company, was being treated like toxic waste. The price of its shares was plummeting, day after day, week after week. To the average investor looking at that falling stock price, the message was clear: get out. This company is in trouble. The verdict of the market was in. But in Omaha, Nebraska, a 43-year-old investor named Warren Buffett was looking at the exact same situation and seeing not a crisis but the opportunity of a lifetime. He was ignoring the flashing red numbers. He was ignoring the panicked headlines. He was ignoring the consensus of Wall Street's brightest minds. Because Warren Buffett was not looking at the price, he was looking at the business. And the business he saw was magnificent. He saw the Washington Post, a newspaper that held a near-monopolistic grip on the political capital of the world. He saw a brand that was synonymous with journalistic integrity, especially as its reporters Bob Woodward and Carl Bernstein were breaking the Watergate story wide open. He saw a powerful television station, a portfolio of other media assets, and a formidable competitive moat that no rival could easily breach. He did what no one else on Wall Street was bothering to do. He sat down and performed a simple, business owner's calculation. He asked, "What would I pay for this entire company if it were a private business for sale down the street?" He ignored the stock market completely. He calculated that the entire enterprise, all of its newspapers, its television stations, its brand equity, was worth, at a conservative estimate, somewhere between $400 and $500 million. Then, and only then, did he glance at the stock market's opinion. And the market, in its infinite panicked wisdom, was offering him the entire Washington Post company for a total market capitalization of just $80 million. The crowd was screaming fire, but Buffett could see there was no fire. The market was offering him a dollar bill of real, tangible business value for 20 cents or less. So while others were panic selling, he began to buy and buy aggressively. He invested over $10 million, a significant portion of his partnership's capital, becoming the company's largest outside shareholder and a trusted advisor to its legendary publisher, Katharine Graham. The world thought he was insane, catching a falling knife. But he knew he was not buying a stock. He was buying a franchise, a toll bridge of information in the nation's capital, and he was getting it at a clearance sale price that bordered on the absurd. The subsequent years, of course, proved him right. As the market panic subsided and the company's incredible earning power continued to assert itself, the stock price eventually had no choice but to gravitate towards the business's intrinsic value. That $10 million investment would, over the next few decades, grow to be worth well over $1 billion, becoming one of the foundational investments that built the Berkshire Hathaway empire. This story is not just a quaint piece of financial history. It is the foundational anecdote for the single most important mental model in all of investing. The price of a stock is not its value. The price is what someone is willing to pay for it at this exact second. The value is a measure of its future earning power, discounted back to today. One is a mood, the other is a fact. And your job as an investor is to exploit the difference between the two. The reason this price-value illusion holds such a powerful sway over the human mind is because it preys on deeply ingrained psychological biases that are hardwired into our cerebral architecture. The primary culprit is a cognitive shortcut known as anchoring bias. When we are presented with a number, any number, our minds instinctively latch onto it as a reference point and anchor for all future judgments. In investing, the most common anchors are the current stock price, the 52-week high, or the price at which we first bought a stock. If a stock we bought at $100 falls to $60, our brain, anchored to that initial $100 price, screams that it is now cheap. If a stock that was recently trading at $200 now trades at $300, our brain, anchored to the past, might feel it is expensive. But both of these judgments are utterly meaningless without an independent calculation of the underlying business's value. The $100, $60, $200, and $300 prices are just arbitrary numbers offered by the market. They tell you nothing about the company's ability to generate cash. Another powerful force at play is recency bias, our tendency to give greater importance to recent events than to distant ones. When a stock's price has been going down for 3 months, our brain extrapolates that trend into the future, assuming the company must be failing. We forget the decades of dominance that came before. Conversely, if a stock has been on a tear for the last year, we become convinced it's a winner that will go up forever. This is the psychological fuel for bubbles and crashes. We mistake recent price action for fundamental information about the business. Warren Buffett's mentor Benjamin Graham understood these psychological failings intimately. To help his students overcome them, he created a brilliant allegory, a mental model to personify the market's irrationality, the story of Mr. Market. Imagine you are business partners with a man named Mr. Market. He is a very obliging partner. Every single day, without fail, he comes to your office and tells you what he thinks your shares in the business are worth. And on that basis, he offers to either buy you out or sell you his shares. The catch is that Mr. Market is a manic depressive. Some days, he shows up in a state of boundless euphoria. He sees only a rosy future for your business, and he quotes you a ridiculously high price for your shares. On other days, he arrives in the depths of despair, convinced that your business and the world are heading for ruin, and he offers you a price that is absurdly, pitifully low. The beauty of this partnership is that you are under no obligation to transact with him. You can listen to his quote and simply say, "No thanks, I'll see you tomorrow." A rational person, Graham argued, would not let Mr. Market's daily mood swings dictate their own assessment of the business's value. You wouldn't sell your stake in a profitable private business just because your partner was having a bad day. You would do your own homework, calculate what the business is actually worth based on its operations and profits, and then you would use Mr. Market, not be used by him. You would happily sell to him when he is euphoric and offering you a crazy high price, and you would gladly buy from him when he is despondent and offering you a bargain. He is there to serve you, not to guide you. The practical application of this wisdom, the blueprint for shattering the price-value illusion in your own financial life, is to formalize this interaction with Mr. Market. It is a three-step mental exercise you must perform every single time you consider an investment. Step 1. Acknowledge the quote. Look at the stock price. See the number flashing on the screen. Let it register. Step 2. Verbally or mentally, thank Mr. Market for his opinion. You can say, "Thank you, Mr. Market, for offering to sell me shares of this company at $50 today." This act of personification creates a crucial psychological distance. You are no longer looking at an objective truth from the market. You are receiving a subjective offer from a known lunatic. Step 3. Immediately and deliberately turn your attention away from his price and toward your own independent analysis of the business's value. Open your notebook, your spreadsheet, your research file, whatever contains your calculated intrinsic value. This is your number, based on the company's earning power, its competitive position, and its future prospects. Let's say your conservative calculation of the business's value is $80 per share. You now have two numbers, his offer of $50 and your calculation of $80. The investment decision becomes trivially easy. Is $50 an attractive price for an $80 asset? Yes, you buy. If, on another day, Mr. Market shows up in a euphoric mood and offers you the same shares for $120, you repeat the process. Thank you for the offer of $120. You look at your $80 valuation. Is it an attractive price? No. You either do nothing or, if you already own the shares, you consider selling your $80 asset to this madman for $120. This simple three-step process forces you to subordinate the market's opinion to your own judgment. It turns you from a passive price taker into an active value assessor. It is the foundational discipline of all intelligent investing. It prevents you from being swept up in the emotional tides of the market and grounds your decisions in the solid bedrock of business reality. This mental model is the core of any sound investment strategy, protecting you from the follies that derail the vast majority of market participants. The path of the 99%, the antithesis of this approach, is the path of the chart watcher and the headline chaser. This is the individual whose entire reality is the screen. They begin their day not by reviewing the operational performance of the businesses they own, but by checking the pre-market futures. Their emotional state for the rest of the day is dictated by the color of the numbers on their brokerage app. They are not investors. They are speculators on squiggly lines. They subscribe to services that promise to predict the short-term direction of those lines, a fool's errand of the highest order. They buy a stock for one reason and one reason only, because the price is going up. This is driven by the fear of missing out. the painful feeling of watching others get rich on a stock you don't own. They have no idea what the underlying business is worth. They only know that the line on the chart is pointing towards the top right corner, and they want in. Conversely, they sell a stock for only one reason, because the price is going down. This is driven by panic and loss aversion. The falling price is interpreted not as Mr. Market having a depressive episode and offering a potential bargain, but as a definitive judgment that the business is failing. They sell at the point of maximum pessimism, often near the bottom, crystallizing a temporary paper loss into a permanent one. The dot-com bubble of the late 1990s was the ultimate monument to this folly. Millions of people, caught in a mass delusion, threw their life savings into companies that had no revenue, no profits, and in many cases no viable business plan. They did this because the stock prices of these dot-com companies were soaring. A company like Pets.com, which sold pet supplies online at a loss, saw its market value skyrocket. People weren't buying a business. They were buying a ticker symbol that was going up. They anchored to the ever-rising prices, and their recency bias told them the trend would last forever. When the inevitable crash came in 2000, these chart watchers and headline chasers were utterly annihilated. They had no anchor of intrinsic value to hold on to. When the price fell 50%, they didn't see a potential bargain. They saw their dreams evaporating. They sold in a panic, locking in catastrophic losses of 80, 90, or even 100%. Their fatal error was mistaking Mr. Market's euphoric babbling for a sound business appraisal. They let the price guide their decisions, and it led them right off a cliff. This is the fate that awaits anyone who cedes their independent judgment to the whims of the crowd. The direct financial connection of mastering this price-value separation is profound and twofold. It is the ultimate tool for capital preservation and the supreme engine for opportunity creation. On the preservation side, it is your shield. When you have done the work to determine that a company has an intrinsic value of $100 per share, and you purchase it at $60, you have built a powerful defense against permanent loss. If the general market panics, and the stock price temporarily drops to $40, you will not panic with it. Why would you? Mr. Market is simply having a worse day, offering you an even better bargain. Your conviction is not tied to the price. It is tied to your analysis of the business. You know the underlying asset is still worth $100. This mindset allows you to weather the inevitable storms of the market without being shaken out of your best positions at the worst possible times. It transforms volatility, the enemy of the speculator, into your greatest ally. For the speculator, a 30% drop in price is a disaster. For the value investor, a 30% drop in the price of a wonderful business they already wanted to own is a gift from the heavens. This leads directly to the opportunity creation side. By training your mind to ignore the noise of the market and focus on the signal of business value, you will be at your most prepared when others are at their most terrified. Periods of maximum pessimism, like 1974 with the Washington Post or the financial crisis of 2008, are when the gap between price and value becomes a gaping chasm. These are the moments when generational wealth is made. While the headline chasers are dumping their high-quality holdings at fire sale prices, you will be there with your shopping list, armed with your independent valuations, ready to calmly and rationally purchase wonderful businesses at fractions of their true worth. This discipline is the very foundation of long-term portfolio growth. It ensures you are systematically buying low and, if you so choose, selling high. It's a simple concept, but one that is impossible to execute without first shattering the price-value illusion. This is the first and most crucial pillar in building a framework for financial freedom. It is the liberation from the tyranny of the ticker. Once you have liberated yourself from the daily tyranny of the stock ticker, the next great transformation must occur. You must cease to think of yourself as someone who buys and sells stocks, and begin to think of yourself as a proprietor who selectively acquires ownership stakes in excellent businesses. This is the owner's mindset. It's a profound psychological shift that changes everything about your approach, from the type of companies you look for to the way you behave during market fluctuations. A stock certificate is not a lottery ticket. It is not a digital token that you hope goes up. It is a legal deed granting you fractional ownership of a real, living, breathing enterprise. You own a piece of the factories, the patents, the brands, the management expertise, and most importantly, a claim on its future profits. When you internalize this fact, the entire endeavor of investing is elevated from a game of chance to an act of commerce. The perfect illustration of this mindset in action took place in 1972 when Warren Buffett and his partner, Charlie Munger, were presented with an opportunity to buy a chocolatier based in California, See's Candies. At this point, Berkshire Hathaway was still primarily a textile business, but Buffett was using its cash to acquire other companies. He was not looking at See's Candies as a stock. He was analyzing it as a potential business to be purchased outright. He and Munger didn't start with the financials. They started by thinking like owners. They observed the almost fanatical loyalty of its customers. They saw people lining up out the door during holidays. They recognized that the See's brand evoked powerful feelings of nostalgia, quality, and tradition, allowing the company to consistently raise its prices year after year without any meaningful loss of business. This pricing power was a goldmine, a sign of a truly wonderful economic franchise. They looked at the simplicity of the business model, making and selling high-quality candy. It was a business they could understand, one that wasn't going to be rendered obsolete by some new technology overnight. Only after they understood the qualitative strengths of the business did they turn to the numbers. The company was being offered to them for $25 million. Buffett, still deeply conditioned by his mentor Ben Graham's cigar butt approach of buying mediocre businesses at dirt-cheap prices, calculated that the tangible assets, the factories, the inventory, were only worth about $8 million. His initial analysis told him that paying $25 million meant paying a $17 million premium for the intangible goodwill of the brand. He balked. He was on the verge of walking away from the deal. It was Charlie Munger who pushed him across the finish line, delivering a piece of wisdom that would fundamentally alter Buffett's entire investment philosophy. Munger argued that a truly wonderful business like See's, with its impregnable brand and pricing power, was worth a premium price. He famously said it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. They were not just buying assets. They were buying an economic engine that would gush cash for decades to come. They made the deal, paying the $25 million. That purchase became a cornerstone of Berkshire Hathaway's success. See's Candies has since generated over $2 billion in pre-tax earnings for Berkshire, cash that was then used to buy other wonderful businesses. The lesson was monumental. When you think like an owner, you prioritize the long-term competitive advantages and earning power of the business itself, not just the liquidation value of its assets. You are buying a future stream of cash flows, and a high-quality, durable stream is worth paying a fair price for. Adopting this owner's mindset is a powerful antidote to some of the most destructive psychological biases in investing. It helps to neutralize the speculative frenzy by engaging a different part of our brain. When you view yourself as a part owner of a business, you instinctively start thinking long-term. This helps to counteract the effects of loss aversion. Loss aversion is the well-documented phenomenon that the pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. For a stock renter, someone with no connection to the underlying business, a 20% drop in the stock price triggers this intense pain, leading to a desire to sell just to make the pain stop. But for a business owner, a 20% drop in the quoted price of their stake is far less terrifying. Imagine you own a share in a highly profitable local restaurant. You know it's packed every night and generates a steady stream of cash. If a broker calls you and says someone is willing to buy your share today for 20% less than yesterday, your first thought isn't to panic and sell. Your first thought is, why? Is the restaurant suddenly doing poorly? If you know the business is still thriving, you'll likely ignore the offer, or even consider buying more if you could. The owner's mindset grounds you in the reality of the business's performance, not the flickering quotation of its stock. Furthermore, it helps harness a positive version of the endowment effect. The endowment effect is our tendency to overvalue something simply because we own it. For a speculator, this can be dangerous. causing them to cling to a losing stock. But for an investor with an owner's mindset, it fosters a sense of stewardship. You become more selective about what you endow yourself with in the first place. You don't just buy a stock, you welcome a business into your family's portfolio. This encourages deeper research and a higher bar for entry, which dramatically improves the quality of the assets you end up owning. You are not renting a ticker symbol for a quick flip. You are acquiring a piece of an enterprise that you intend to hold for a very long time, just as you would a piece of income-producing real estate or a family business. The blueprint for cultivating this owner's mindset is a research method that the legendary investor Philip Fisher, a major influence on Buffett, called scuttlebutt. It's the process of becoming an investigative journalist about the company you are considering buying. It moves beyond the numbers on a financial statement and into the real world. The core instruction is this: before you invest a single dollar, pretend you have been given the opportunity to buy the tire sumps company for cash, using your family's entire net worth. The decision is irreversible. What would you absolutely have to know before you signed that check? This question forces a level of diligence that 99% of investors never even contemplate. The scuttlebutt method has several key steps. First, analyze the product or service yourself. If it's a software company, use the software. If it's a retailer, visit the stores. If it's a restaurant chain, eat the food. Is the product truly superior? Is the service excellent? Would you be a happy customer? Second, talk to the customers. Why do they choose this company over its competitors? Is it price, quality, convenience, or brand loyalty? How likely are they to switch? This gives you an on-the-ground sense of the company's competitive standing. Third, investigate the competition. What are they doing right? What are their weaknesses? How does your target company stack up? This helps you understand the competitive landscape and the durability of any advantage your company might have. Fourth, if possible, understand the employee morale. Read reviews on sites like Glassdoor. Are employees happy and motivated? A toxic culture can be a leading indicator of future business problems. Finally, after gathering all this qualitative information, you must write a simple one-page investment thesis. This is not a complex financial model. It is a simple memo to yourself that begins with the sentence, "I am purchasing an ownership stake in this business because," and then lists in plain English the 3 to 5 key reasons why you believe this is a superior enterprise with excellent long-term prospects. This entire process, the scuttlebutt investigation and the one-page thesis, forces you to think like a business analyst, not a stock picker. It builds deep conviction. When the market inevitably panics and the stock price of your company drops by 30%, you won't be scared. You'll be able to reread your thesis, remind yourself why you bought the business in the first place, and confidently hold on or even buy more. You will have an anchor in a storm of your own making, built from deep business knowledge. The antithesis of the owner's mindset is the path followed by the vast majority of market participants, the path of the stock collector. The stock collector views the market as a place to amass a large number of different ticker symbols. They might brag at a cocktail party that they, quote, own 50 stocks. Their brokerage statement looks like a stamp collection, with tiny positions in dozens of different companies. This approach is often mistakenly labeled as diversification, but in reality it is what Peter Lynch called diversification. It is an admission of a complete lack of conviction. The stock collector knows the price of everything they own, but the value of nothing. They can tell you what their stocks did yesterday, but they can't tell you what the underlying businesses do or what their competitive advantages are. They buy stocks based on a story they heard on TV, a tip from a friend, or because a company is in a hot sector like artificial intelligence or electric vehicles. Because they have no deep understanding of the businesses they own, they have no basis for holding them during a downturn. When a stock falls, they have no investment thesis to fall back on, only the painful red number on their screen. So they sell, often near the bottom, and move on to the next hot tip, repeating the cycle of wealth destruction. Their portfolio is a mile wide and an inch deep. The small gains from any winners they might stumble upon are inevitably diluted by the losses from their many losers and their poor market timing. They are constantly active, trading in and out of positions, racking up transaction costs and tax bills, all under the illusion that they are being savvy investors. In reality, they are simply generating fees for their broker and creating a portfolio that is destined for mediocrity at best. The stock collector is playing a game of chance, hoping to get lucky. The business owner is engaging in a disciplined process of capital allocation, stacking the odds overwhelmingly in their favor. The direct financial connection of adopting an owner's mindset is that it naturally leads to a higher quality, more concentrated, and ultimately more profitable portfolio. When you raise the bar for investment to the level of buying an entire business, you become incredibly selective. You will find that only a tiny fraction of public companies meet your stringent criteria. This naturally leads you to build a portfolio of a smaller number of truly exceptional businesses that you understand deeply. This type of concentrated portfolio, while it may seem riskier to the diversifier, is in fact safer. Your risk is not managed by owning 100 mediocre companies, but by intimately knowing the 10 or 15 wonderful companies you own. This deep knowledge gives you the conviction to hold on during periods of volatility and to add to your positions when they are offered at bargain prices. The financial result is superior long-term compounding. A portfolio of a few world-class businesses, held for many years, will almost inevitably outperform a scattered collection of mediocre ones. The returns generated by a company like See's Candies, Apple, or Coca-Cola, if held for decades, can be life-altering. This is how real wealth management works at the highest levels. It is not about frantic activity. It is about making a few great decisions and then having the patience to let them compound. This mindset shift is the bridge from simple stock picking to building a genuine, long-term investment strategy. It transforms your relationship with your capital from one of speculation to one of stewardship, paving the way for substantial and sustainable portfolio growth and, ultimately, true financial freedom. You have now broken the price-value illusion and adopted the mindset of a business owner. The next pillar is the most crucial, the engine room of the entire process. It is where we translate theory into practice. We must now learn how to systematically and rationally calculate a conservative estimate of a company's true earning power. This is the skill that allows you to look at any business and determine its approximate intrinsic value, the number that serves as your anchor of reality in the swirling seas of market sentiment. We are going to demystify the process of fundamental analysis and equip you with a tool that Warren Buffett himself has described as the most important metric for valuation: owner's earnings. To understand its power, we must journey to the year 1988. The stock market was still shell-shocked from the Black Monday crash of October 1987, when the Dow Jones Industrial Average plummeted by over 22% in a single day. Fear was still palpable. But Warren Buffett, as usual, was not fearful. He was greedy. He saw the wreckage of the crash not as a disaster, but as a field of opportunity, littered with the shares of wonderful businesses that were now on sale. And one business in particular caught his eye: the Coca-Cola Company. To the outside world, Coke was just another stock that had been punished by the crash. But to Buffett, armed with his owner's mindset, it was one of the greatest businesses on earth. He saw a product that was simple, universally desired, and sold in nearly every country on the planet. He saw a brand that was not just a logo but a cultural icon, representing happiness and American identity. This brand gave Coca-Cola a near-impregnable moat around its business. But the beauty of the brand was not just an abstract concept for Buffett. He wanted to know how it translated into cold, hard cash for its owners. So he did what he always does. He sat down with the company's annual reports and began to calculate its true, underlying earning power. He wasn't interested in the reported net income that most analysts obsessed over. He knew that accounting earnings could be misleading. He wanted to know about the cash. Specifically, he wanted to calculate what he called owner's earnings. His formula is simple in concept. It starts with reported net income, adds back non-cash charges like depreciation and amortization, and then subtracts the average amount of money the company has to spend on capital expenditures, the new bottling plants, trucks, and machinery, just to maintain its competitive position and unit volume. The resulting number is the true prize, the amount of cash that the business generates in a year that can be returned to the owners to do with as they please, to pay dividends, buy back shares, or make acquisitions. It is the surplus cash, the real profit. Looking at Coca-Cola in 1988, Buffett saw a cash generation machine of epic proportions. The company was a global toll road on human thirst. Its capital expenditure needs were relatively modest compared to the enormous amount of cash its global sales brought in. He calculated this stream of owner's earnings and then compared it to the total price tag the stock market was putting on the entire company, its market capitalization. What he saw was a world-class, indestructible business selling at a price that represented a very high cash-on-cash return for a new owner. The market, still spooked by the crash, was undervaluing this incredible stream of future cash. Convinced by his analysis, Buffett invested over $1 billion, buying up roughly 7% of the company. It was a massive bet. Once again, the world was skeptical. But Buffett wasn't betting on the stock market. He was buying a predictable, growing stream of cash at a fantastic price. That $1 billion investment in Coca-Cola stock would go on to become one of his most successful ever, growing more than tenfold over the following decade and gushing billions of dollars in dividends back to Berkshire Hathaway, proving the immense power of focusing on the real cash earnings of a business, not the fickle opinions of the market. The reason this focus on owners' earnings is so powerful is that it acts as a potent weapon against one of the most insidious cognitive biases in investing: confirmation bias. Confirmation bias is our natural tendency to search for, interpret, favor, and recall information that confirms our pre-existing beliefs. When we get excited about a company's story, a revolutionary new technology, a visionary CEO, we instinctively start looking for data that supports our initial enthusiasm. We'll focus on exciting metrics like revenue growth or user growth, while conveniently ignoring less glamorous but more important figures. The owner's earnings calculation is a harsh, unforgiving dose of reality. It doesn't care about a company's narrative or its stock's popularity. It asks one simple, brutal question. After all the bills are paid and all the necessary reinvestments are made to keep the business running, how much cash is actually left over for me, the owner? This cold, quantitative process forces you to confront the economic reality of the business. You might love the story of a fast-growing tech company, but if the owner's earnings calculation reveals that it is burning through cash and its massive revenue growth requires even more massive capital expenditures, it forces you to question your initial thesis. It's a built-in BS detector. It grounds you in the physics of business, which is that, ultimately, a business is only worth the cash it can produce for its owners over its lifetime. By committing to this calculation, you are deliberately choosing to fight your own confirmation bias. You are replacing a subjective story with an objective measure of financial health. It is the difference between falling in love with a company's potential and making a sober assessment of its actual performance. It is the discipline that keeps you from overpaying for hype and guides you toward businesses that produce real, tangible cash. Now let's translate this into a practical, applied mental model that you can use. You don't need a PhD in finance to get a solid, conservative estimate of a company's owner's earnings. We can create a simplified blueprint using publicly available financial statements. Step 1. Pull up the company's most recent annual report, which you can find for free on their investor relations website. Go to the consolidated statements of cash flows. This statement is the key because it tracks the actual cash moving in and out of the business, unlike the income statement, which is based on accrual accounting. Step 2. Find the line item cash flow from operating activities. This is your starting point. It represents the cash generated by the company's core business operations before any major investments. Write this number down. Step 3. On the same cash flow statement, look for a line item in the investing activities section, usually called capital expenditures or purchases of property, plant, and equipment. This is the money the company had to spend on maintaining and upgrading its physical assets. Because this number can fluctuate year to year, it's best to take an average of the last 3 to 5 years to get a more stable, representative figure. Step 4. The calculation. Take your cash flow from operating activities and subtract the average capital expenditures you just calculated. The result is your conservative estimate of free cash flow, a very close proxy for Buffett's owner's earnings. This is the number that matters. This is the cash that is truly free to be distributed to shareholders. Step 5. The valuation. Now, take that free cash flow number and compare it to the company's total market capitalization, which you can find on any financial website. Divide the free cash flow by the market cap. This gives you the free cash flow yield. For example, if a company has a market cap of $1 billion and it generates $100 million in free cash flow, its yield is 10%. This is an incredibly powerful valuation tool. You can ask yourself, if I bought this entire business today, my initial cash-on-cash return would be 10%. You can then compare that yield to other investments, like the yield on a government bond. Is a 10% return from this business, with its potential for growth, more attractive than a 4% return from a risk-free bond? This simple, 5-step process transforms you from a passive consumer of market prices into an active calculator of business value. It gives you a reliable framework for determining if a stock is cheap, fair, or expensive, based on its real-world ability to generate cash. The antithesis of this rigorous, cash-focused approach is the path followed by millions of amateur investors, the path of the price-to-earnings, P/E ratio worshiper. The P/E ratio is perhaps the most widely cited valuation metric in finance. It's simple, readily available, and seems to offer a quick answer to the question, is this stock cheap? An investor might see a company with a low P/E ratio of 8 and conclude it's a bargain, while dismissing another with a P/E of 30 as expensive. But relying solely on the P/E ratio is one of the most dangerous traps in investing. The E in P/E stands for earnings, or net income, which, as we've discussed, is an accounting figure, not a cash figure. Net income can be easily manipulated through various accounting choices, making a company appear more profitable than it actually is. More importantly, net income completely ignores the crucial element of capital expenditures. A company can report high earnings but be a terrible business if it has to constantly spend enormous sums of money just to stay in the game. Consider a classic value trap, a capital-intensive industrial company, like an airline or an old-school manufacturer. It might trade at a P/E ratio of 7, looking incredibly cheap on the surface. An analyst might praise its high, quote, earnings. But when you perform the owner's earnings calculation, you discover a grim reality. The company may have generated $1 billion in cash from operations, but it had to spend $950 million on new airplanes or factory upgrades just to keep its fleet or facilities from becoming obsolete. Its true free cash flow, the cash available to owners, is only $50 million. The business is a giant capital incinerator, running hard just to stay in place. The P/E ratio worshiper is fooled by the accounting earnings, but the owner's earnings calculation reveals the truth. They have bought a value trap, a business that is cheap for a very good reason. It doesn't actually generate much cash for its owners. This is why a deep understanding of financial analysis, specifically the ability to discern cash flow from accounting profit, is a non-negotiable skill for any serious investor. It is the X-ray vision that allows you to see the true economic health of a business, protecting you from the market's most seductive illusions. The direct financial connection of mastering this owner's earnings calculation is that it fundamentally changes your stock picking and portfolio construction for the better. Your focus shifts from speculative stories to financial resilience. By prioritizing businesses with strong and growing free cash flow, you are naturally selecting for companies with superior business models. These are companies that can fund their own growth without needing to constantly borrow money or issue new stock, which dilutes your ownership. They have the financial firepower to pay and increase dividends, to opportunistically buy back their own shares, increasing your ownership percentage, or to acquire other businesses to fuel further growth. These are the characteristics of long-term compounders, the engines of real wealth creation. On a portfolio level, this skill acts as a powerful quality filter. It ensures that your portfolio is not filled with speculative bets or asset-heavy value traps, but with a collection of cash-generating machines. This creates a far more resilient portfolio, one that is better able to withstand economic downturns. Companies with strong cash flow have options. Companies that are burning cash are at the mercy of the capital markets. This ability to perform your own financial analysis, to arrive at your own estimate of value, is the ultimate source of investment conviction. It is what allows you to make significant, executive-level decisions with your own capital, confident that you are operating based on fact, not on market sentiment. The end result is a portfolio with a higher probability of beating the market over the long term, creating a clear and reliable path towards significant portfolio growth and the financial independence that comes with it. This is not just a technique. It is a cornerstone of a sound financial education. You now possess the owner's mindset and the engine to calculate a business's true earning power. You can distinguish between a good business and a bad one. But this is not enough. A great business can be a terrible investment if you pay too much for it. The fourth pillar is the crucial defensive component of the entire strategy. It is the element that protects you from your own fallibility and from the unpredictable nature of the world. This is the principle of the margin of safety. It is the idea that you must not only calculate what a business is worth, but you must then demand to buy it at a significant discount to that calculated value. This discount, this margin of safety, is your fortress. It is the impenetrable moat around your capital that protects you from the arrows of misfortune and miscalculation. The purest and most powerful illustration of this concept comes not from Warren Buffett, but from his teacher and mentor, the father of value investing, Benjamin Graham. In the late 1940s, Graham's investment firm was analyzing a sleepy, obscure company called the Northern Pipeline Co. On the surface, it was an unexciting business. But Graham, a master of forensic accounting, wasn't interested in its operations. He was interested in its balance sheet. In his investigation, he made a startling discovery. The company's stock was trading on the market for about $65 per share. However, when he looked at the company's assets, he found that it owned a portfolio of high-quality corporate and municipal bonds. He painstakingly valued this bond portfolio and found it was worth approximately $95 for every share of stock outstanding. The situation was breathtakingly simple. By paying $65 for a share of Northern Pipeline, he was in effect purchasing $95 worth of safe, liquid bonds. He was buying a dollar bill for 68 cents. And that wasn't all. The company also owned a pipeline business. The pipeline itself had value and generated some profit, but in Graham's calculation that was irrelevant. He was getting the entire operating business for free, thrown in as a bonus. The margin of safety was enormous. The success of the investment was not dependent on the future success of the pipeline, or the economy, or the stock market. The value was right there, locked in the balance sheet, on the day of purchase. It was almost impossible to lose money. Even if the pipeline business went bankrupt and was worth zero, he still had an asset worth $95 that he had paid $65 for. This, for Graham, was the pinnacle of intelligent investing. It was not about forecasting or prediction. It was about creating a situation where the odds were so overwhelmingly stacked in your favor at the outset that a positive outcome was a near certainty. The margin of safety was not just a cushion, it was a guarantee. It was the ultimate protection against the unknown. This insistence on a margin of safety is not just a conservative financial tactic. It is a profound psychological tool for combating our own innate cognitive flaws. The two most relevant biases here are overconfidence bias and the planning fallacy. We are, as a species, incorrigibly optimistic about our own abilities and the accuracy of our forecasts. We believe we are better than average drivers, have a better than average sense of humor, and are better than average investors. This overconfidence leads us to create financial models and projections that are often unrealistically rosy. We project high growth rates far into the future, assuming everything will go right for the company we are analyzing. The planning fallacy is a specific manifestation of this, where we consistently underestimate the time, costs, and risks of future actions, and overestimate the benefits. We plan for the best-case scenario. The margin of safety is the explicit, built-in antidote to this human tendency. It is a structural admission of humility. When you insist on buying a stock for 50 cents that you believe is worth $1, you are saying, "I know my calculation of that $1 of value is probably wrong." The future is unknowable. Management could make a mistake. A new competitor could emerge. The economy could enter a recession. My forecast could be off by 10, 20, or even 30%. The margin of safety protects you from this inevitable fallibility. If the intrinsic value you calculated at $100 per share turns out to be only $80 in reality, your purchase at $50 still yields a handsome profit. If your calculation was wildly optimistic and the true value is only $60, you still break even or make a small gain. You have built a buffer for error directly into your process. You are acknowledging that the future is a realm of probabilities, not certainties, and you are positioning yourself to succeed even if your predictions are flawed. It is the most intellectually honest way to invest, because it starts with the premise that you are not a clairvoyant. The blueprint for applying this fortress-building principle is a simple but brutally disciplined rule, the 50-cent dollar rule. This is a non-negotiable step that follows your intrinsic value calculation from the previous pillar. Step 1. Perform your detailed analysis of the business and calculate a conservative estimate of its intrinsic value. Let's say, after all your work, you confidently believe that XYZ Corporation is worth $100 per share. This number, $100, is your value line. You should write it down and treat it as a sacred figure. Step 2. Immediately and without emotion, calculate 50% of that value. In this case, $50 per share. This is your purchase line. This line is your trigger point for action. Step 3. Institute a rigid personal policy. You are only permitted to buy shares of XYZ Corporation if and when Mr. Market, in one of his depressive fits, offers them to you at or below your $50 purchase line. You will not nibble at $70. You will not be tempted at $60. Your discipline must be absolute. The zone between $50 and $100 is a dead zone for buying. Step 4. Understand the 3 ways this margin of safety makes you win. Scenario A. You were right. The business is indeed worth $100. As the market's pessimism subsides, the stock price eventually rises to reflect this value, and you double your money. Scenario B. You were a bit optimistic. The business faces some headwinds you didn't anticipate, and its true value is only $80. You still make a 60% return on your $50 purchase. A fantastic result born from a flawed forecast. Scenario C. You were dead wrong. A key product failed, and the business is only worth $60. You still get your money back and earn a small profit. Your margin of safety transformed a potential analytical disaster into a non-losing proposition. This 50-cent dollar rule takes the emotion out of the buying decision. It replaces hope and greed with a cold, mechanical process. Your job is not to predict where the stock price will go tomorrow, but simply to calculate value, set your purchase price, and wait. The path of the 99% stands in stark, disastrous contrast to this disciplined approach. It is the path of growth at any price, or more accurately, buying high and praying it goes higher. This investor finds a genuinely wonderful company. It could be a dominant technology firm, a revolutionary biotech company, or a trendy consumer brand. They do their research, and they correctly identify that this is a superior business with a bright future. But then they commit the cardinal sin. They fall in love with the story and completely disregard the price. They see the stock trading at a P/E ratio of 100 or a price-to-sales ratio of 20. valuations that leave absolutely no room for error. But they justify it with narratives. This time is different. The growth potential is unlimited. You have to pay up for quality. They are buying with no margin of safety whatsoever. The entire success of their investment rests on a single fragile assumption: that the company's future growth will be not just good, but spectacularly, flawlessly perfect, exceeding even the market's already sky-high expectations. This is a recipe for disaster. The historical landscape is littered with the corpses of such investments. The Nifty 50 stocks of the early 1970s were wonderful companies like Coca-Cola, McDonald's, and IBM. Investors, convinced they were one-decision stocks you could buy and never sell, bid their prices up to astronomical levels. When the 1973-74 bear market hit and their growth slowed even slightly, their stock prices collapsed by 60, 70, or even 80%. It took investors who bought at the peak over a decade just to get back to even, despite owning shares in world-class enterprises. More recently, the tech bubble of 2020 and 2021 saw a repeat of this madness, with innovative, exciting companies trading at valuations that priced in decades of perfect execution. When interest rates rose and sentiment shifted, many of these stocks fell by over 80%, wiping out years of gains for those who had bought near the top. The lesson is brutal and unchanging. Even the best business in the world can be a catastrophic investment if you overpay for it. The lack of a margin of safety turns a wonderful asset into a speculative time bomb, waiting for a single piece of bad news to detonate. The direct financial connection of rigorously applying a margin of safety is that it is the single most powerful driver of superior risk-adjusted returns. It is the magic ingredient that simultaneously lowers your risk while increasing your potential reward. The risk-lowering aspect is obvious. By buying at a significant discount, you dramatically reduce the probability of suffering a permanent loss of capital, which is the #1 enemy of long-term compounding. A single 50% loss requires a 100% gain just to get back to where you started. The margin of safety is your primary defense against such crippling setbacks. The return-enhancing aspect is more subtle, but just as powerful. When you buy a $100 asset for $50, your upside potential is not just to $100. If the business continues to grow and its intrinsic value increases to $120, your return is even more magnificent. The discount acts as a coiled spring, amplifying your future returns. On a portfolio level, this discipline creates a structure that is inherently asymmetric. Your downside is capped by the discount you demand, while your upside remains open to the long-term growth of the businesses you own. This is the mathematical key to building wealth in the stock market. It moves you away from the 50-50 coin flip of speculation and into a domain where your investments have a high probability of success built in from the start. This is the very essence of professional wealth management and a foundational pillar of any financial education that aims to create resilient, long-term investors. It is the reason that value investing, as a strategy, has endured for nearly a century. It is built not on optimism, but on a humble and profitable respect for the unpredictable nature of the future. We have now assembled the core intellectual machinery of a billionaire investor. You know how to separate price from value. You know how to think like a business owner. You know how to calculate a company's earning power, and you know you must demand a margin of safety before you act. But there is one final pillar, and it is perhaps the most difficult of all, because it is not analytical, but behavioral. It is the discipline that breathes life into the entire framework. It is the art of the patient predator, the ability to sit still, to do nothing, and to wait for the perfect pitch. You can have all the analytical skills in the world, but if you lack the emotional fortitude to wait for the rare moments when a great business is offered at a ridiculously cheap price, the entire system is useless. The ultimate case study in this supreme discipline is Warren Buffett's conduct during the height of the dot-com bubble in 1999. The market was in a state of collective mania. Any company with .com in its name was soaring to unbelievable valuations, regardless of its business fundamentals. Meanwhile, solid, profitable, old economy businesses, the kind Buffett understood and favored, were being left in the dust, scorned as relics of a bygone era. For the first time in decades, Buffett's performance was dramatically lagging the S&P 500. The financial press, which had once worshipped him as a genius, turned on him with a vengeance. The prestigious financial magazine Barron's ran a now infamous cover story with the headline, "What's Wrong, Warren?" The article suggested that he had lost his touch, that he was a dinosaur who didn't understand the new technological paradigm. The pressure was immense. His shareholders were grumbling. His peers were getting fabulously rich, on paper, by buying tech stocks. Every psychological force, every social pressure, was screaming at him to abandon his discipline and join the party. But Buffett did nothing. He patiently sat on billions of dollars in cash. He admitted publicly that he didn't understand the valuations of these new technology companies, and that he refused to play a game where he couldn't calculate the odds. He famously compared investing to baseball, saying the key was to wait for the perfect pitch right in your sweet spot. In investing, there are no called strikes. You can stand at the plate and watch thousands of pitches. Overvalued companies, businesses you don't understand, speculative fads, go by, and it costs you nothing. Your goal is to wait for that one perfect, slow, fat pitch, and then, and only then, swing with everything you've got. For Buffett in 1999, every pitch looked like a 150-mile-per-hour fastball aimed at his head, so he kept the bat on his shoulder. Then, in March of 2000, the bubble burst. The Nasdaq crashed. The dot-com darlings evaporated. The paper fortunes of the tech speculators were wiped out. And Warren Buffett the dinosaur was sitting there with his mountain of cash, ready to go shopping. He had endured the ridicule, resisted the temptation, and his patience was rewarded with a historic opportunity to buy the world's best businesses at bargain basement prices. His performance in the subsequent years was spectacular. His discipline had not only protected his investors from the crash, but had positioned them to profit massively from its aftermath. This incredible feat of emotional control is a direct assault on two of the most powerful and primal human urges, the action bias and the fear of missing out, FOMO. Our brains evolved in an environment where immediate action was often necessary for survival. When we saw a threat or an opportunity, the instinct was to do something now. This translates into the modern world of investing as the action bias, the feeling that we must always be doing something with our portfolio, buying, selling, rebalancing. Sitting still and holding cash feels unproductive, lazy, and wrong, even when it is the most intelligent strategic move. Compounding this is FOMO, a social contagion amplified by the 24/7 news cycle and social media. We are constantly bombarded with stories of people getting rich on the latest hot stock, the newest cryptocurrency, the next big thing. This triggers a powerful anxiety, a fear that we are being left behind, that everyone else is on a train to prosperity, and we are stuck at the station. This combination of the action bias and FOMO is a lethal cocktail for investors. It compels them to chase performance, to buy assets at the peak of their popularity and price, and to constantly churn their portfolio in a desperate attempt to catch every trend. The discipline of the patient predator is the conscious, deliberate act of overriding these deep-seated instincts. It is the understanding that in investing, your long-term results are often defined not by the brilliant moves you make, but by the stupid things you avoid doing. It is the recognition that activity is frequently the enemy of returns, and that true portfolio growth comes from long periods of inactivity punctuated by rare moments of decisive, well-researched action. To cultivate this rare discipline, Buffett offers another powerful mental model, the 20-slot punch card model. He once advised students to imagine that at the beginning of their investment career, they are handed a punch card with only 20 slots in it. These 20 punches represent the total number of investments they are allowed to make in their entire lifetime. Every time they buy a stock, they must punch a hole in the card. Once the 20 slots are filled, they can never make another investment. This single thought experiment radically transforms your decision-making process. The blueprint is to operationalize this model. First, create a physical or digital representation of your 20-slot punch card. Seeing it makes it real. Second, before you ever execute a trade, you must hold it up against the punch card test. Ask yourself, is this business so wonderful? Is my understanding of it so deep? And is the price so cheap with such a massive margin of safety that I am willing to commit one of my precious, non-replaceable 20 lifetime punches to it? This question dramatically raises the bar. You would no longer waste a punch on a speculative whim, a hot tip, or a mediocre company. You would reserve your punches for the absolute slam dunks, the true, fat pitch opportunities that come along only a few times a decade. Third, this forces you to think in terms of decades, not quarters. You wouldn't use a lifetime punch on something you plan to sell in 6 months. You would only use it on an enterprise you would be comfortable owning for the next 10, 20, or 30 years. This mental model is the ultimate cure for hyperactivity. It forces you to adopt the mindset of a patient capital allocator, not a frantic trader. It aligns your behavior with the reality that great investment opportunities are rare, and that true success comes from concentrating your capital and your mental energy on a very small number of outstanding ideas. This is the essence of professional executive decision-making when it comes to capital. The antithesis of the patient predator is the all-too-common hyperactive trader. This individual lives in a state of constant motion. Their screen is filled with charts, news feeds, and flashing alerts. They believe that their success is directly proportional to the amount of activity they generate. They are always chasing the latest narrative, jumping from a clean energy stock one week to a biotech stock the next, always a step behind the smart money. They listen to the financial news pundits as if they were prophets, buying on their recommendations and selling when the story changes. They are obsessed with beating the market on a daily or weekly basis, an impossible and self-defeating goal. The financial consequences of this hyperactivity are devastating. First, they are bled dry by transaction costs. Every buy and sell order nibbles away at their capital. Second, they become a ward of the state through taxes. By constantly selling winners after holding them for less than a year, they pay the highest possible short-term capital gains tax rates, decimating the power of compounding. Third, and most importantly, their constant action makes them a perpetual victim of market psychology. They are guaranteed to buy high, swept up in the euphoria of a rising stock, and sell low, purged by the terror of a market downturn. They are the prey. They are the liquidity that the patient predators, the Warren Buffetts of the world, feast upon. Their portfolio growth is a chaotic, jagged line that trends sideways or downwards over time, a testament to the fact that in the world of investing, effort and results are often negatively correlated. They mistake motion for progress and activity for achievement, and they pay a terrible price for that confusion. The direct financial connection of cultivating this supreme patience is that it is the ultimate amplifier of returns. By waiting for the perfect pitch, a wonderful business you understand, trading at a 50% margin of safety, you are ensuring that the capital you deploy is put to work in only the highest conviction, highest probability of success situations. This concentration of capital on your very best ideas is what leads to the kind of explosive, multi-bagger returns that create life-changing wealth. A portfolio built on 20 carefully selected, deeply understood businesses bought at fantastic prices will, over a lifetime, annihilate the returns of a portfolio that was churned 1,000 times. Furthermore, this low-turnover, long-term approach is incredibly tax-efficient. By holding your winners for many years, you allow your capital to compound without the annual haircut of capital gains taxes. The government becomes your silent partner, allowing your wealth to grow untaxed until the day you finally choose to sell, decades down the road. This combination of superior stock picking and extreme tax efficiency is the dual-engine jet that powers portfolios toward the destination of financial freedom. It is the final behavioral key that unlocks the full power of the value investing framework. It completes the journey from a reactive speculator, tossed about by the whims of the market, to a proactive, patient, and ultimately prosperous business owner. This is the final promise of a sound investment strategy. Not just the potential for wealth, but the gift of peace of mind. You have made it to the end of this journey, and in doing so, you have invested something far more valuable than money. You have invested your time and your focus. That investment has armed you with a powerful new lens, the very same lens a billionaire investor uses to view the financial world. You now understand the fundamental truth that the stock price is a lie, a fleeting opinion, while the value of a business's earning power is the bedrock of reality. You have learned how to calculate that value, to demand a discount through a margin of safety, and to cultivate the supreme patience required to wait for the perfect opportunity. This framework is not just a collection of tips, it is a complete, cohesive system for making rational, high-probability investment decisions. You now possess the tools to protect your capital from the emotional whims of the crowd and to position yourself to profit from them. But it is crucial to understand that this is only one part of a much larger map. This valuation framework is a powerful weapon, but a weapon is only as effective as the target it is aimed at. Knowing how to value a business and time when times to buy it is only half of the equation. The other, equally critical half is knowing what kind of businesses are worthy of your valuation in the first place. Warren Buffett's true genius lies not just in his ability to buy cheap, but in his ability to identify businesses with impenetrable competitive moats, the durable, structural advantages that protect their profits from competitors for decades. A cheap business without a moat is a value trap, but a fairly priced business with a great moat can be the foundation of generational wealth. The video that is now appearing on your screen is the missing link. It is the next piece of the map. It delves deep into this concept of economic moats, teaching you how to identify the fortress-like businesses that are the only worthy candidates for the valuation method you have just mastered. It connects the how-to value with the what-to value. Most people will stop here, satisfied with the powerful tool they have just acquired. But you did not come this far to be like most people. You are on a path of transformation, building a complete mental arsenal to achieve financial sovereignty. The choice to click is more than just a choice to watch another video. It is a declaration that you are committed to completing your education. It is the next step in your ascent from a speculator into a true capital allocator. Complete your map. The puzzle of wealth is waiting to be solved, and the next piece is right there in front of you.